Welcome to This Explainer. Have you ever stopped to wonder how exactly a massive fleet of robotic, zero-emission mining trucks out in some remote desert, or even a bleeding-edge blockchain project, how do they actually get the millions of dollars they need to go global? I mean, it doesn't just happen by magic, right? And it rarely happens through traditional neighborhood banks. No, it happens through highly structured, incredibly fast-paced financial vehicles. So today, we're going to unpack exactly how tomorrow's tech gets funded and brought to the public market. Let's get into it.
Here's a quick look at our agenda. 1. The zero-emission hook. 2. We'll break down the de-SPAC mechanism. 3. Finovate meets Skage. 4. Launching the next SPAC. And finally, 5. Funding the digital future.
All right, Section 1, the zero-emission hook, heavy-duty tech in action.
To kick things off, we're actually starting our journey far, far away from the busy trading floors of Wall Street. We're heading to the incredibly harsh, demanding environment of an open-pit mine in Wani, Yemen. Now, think about the number 100. That is the exact number of XCMG unmanned electric mining trucks that were recently delivered to this remote spot. And guys, we are not talking about your average pickup trucks here. We are talking about an intelligent, massive cluster of autonomous heavy machinery that's capable of continuous operation. They function perfectly even when it drops to a freezing minus 40 degrees Celsius. Now, the sheer environmental efficiency of this tech is frankly staggering. By using a pure electric drive system, 5G communication, and get this, a fully automatic battery swap that takes literally just 6 minutes, this single fleet replaces more than 15,000 tons of diesel every single year. To put that into perspective, that translates to cutting carbon dioxide emissions by 48,000 tons annually. They've essentially achieved absolute zero carbon operation in their transportation process. It's a real game changer. But this brings us to a really crucial question. How exactly do these capital-intensive next-gen innovations get the funding they need to scale up globally? Because developing proprietary e-fuel tech and autonomous systems, that requires massive upfront capital. Traditional bank loans just aren't going to cut it, and staying private severely limits how fast you can grow. So they absolutely need access to the vast pools of capital floating around in the public markets. The catch is, how do they get there quickly and efficiently? Which leads us perfectly into Section 2, the de-SPAC mechanism, from blank check to public market. Now, to understand a de-SPAC, we first got to know what a SPAC actually is. According to Intuit's Financial Management Guide, you can think of a special purpose acquisition company, or SPAC, as an empty financial shell. It essentially raises money from the public with one singular goal, to go out and buy an exciting, promising private company. When that merger actually happens, well, that's what we call a de-SPAC transaction. And boom, instantly the private company gets a massive injection of capital, becomes publicly traded, and dramatically broadens its opportunities and brand awareness. So when you compare the two pathways, de-SPACs could offer some really distinct advantages over a traditional IPO. Say you're a company developing unique green technologies. A de-SPAC gives you a much faster runway to the public markets. And crucially, it offers a certainty of valuation, basically because the price is pre-negotiated between the SPAC and the target company. An IPO, on the other hand, is notoriously time-consuming, and the valuation constantly fluctuates based on unpredictable market demand. But there is a catch. You knew there would be. De-SPACs are heavily scrutinized by the SEC, they carry risks of overvaluation, and they face potential shareholder redemptions, which is basically when investors get cold feet and pull their money out right before the merger closes. The Intuit Guide breaks this rapid-fire process down into 5 main steps. First up, you find a target with massive growth potential. Second, you negotiate that merger agreement and lock in the valuation. Third, you push through all the heavy SEC paperwork, like the S-4 registration statement. Fourth, you secure shareholder approval and aggressively close the deal. And finally, step 5, you fulfill those strict post-merger SEC reporting obligations. From start to finish, this highly orchestrated sprint usually only takes about 3 to 6 months. All right, Section 3, Finovate meets Skage, a real-world merger. Let's actually look at how this plays out in reality. Back in November 2021, the blank check company Finovate raised its initial capital. Fast forward a bit to August 2023, and they signed a business combination deal with Skage. Now, Skage is a company making exactly the kind of electric mining trucks we were looking at earlier. After successfully navigating all that heavy SEC scrutiny, the new combined company officially hit the NASDAQ in June 2025 under the ticker symbol SCAG. And by January 2026, they were a fully realized public entity filing their F1 registration forms.
So, what does all this complex financial maneuvering actually buy? Well, according to Baker McKenzie, the global law firm that advised on the deal, it buys massive growth. Skadge is now using those newly acquired public funds to actively accelerate the commercialization of their next-gen hybrid, battery electric, and hydrogen fuel cell trucks. They're rapidly expanding their production capacity and really doubling down on investing in hydrogen infrastructure to build out their global footprint.
Moving on to Section 4, launching the next SPAC, the Aperture AC story.
You see, once a management team successfully executes a de-SPAC, they rarely just pack up and stop there. Take Kelvin Kung, for example. He's the chairman and CEO who successfully navigated that Finovate SPAC and took Skage public. Now he's taking all of that highly specialized expertise in capital raising, SEC filings, and target acquisition, and he's pivoting to lead a brand new entity called Aperture AC.
Looking at their recent SEC S1 filing, Aperture AC is targeting a massive $90 million blank check offering. But I want you to notice the financial structure here. Upon the consummation of the offering, the initial sponsors retain a 27% stake in founder shares. Now, while this absolutely incentivizes the management team to go out and find a great target, the filings do neutrally note a potential catch for regular retail investors. This low buy-in price for sponsors can actually result in immediate dilution for public shareholders when the merger finally happens. It's basically a built-in calculated risk of this specific model.
And that brings us to Section 5, funding the digital future, the next frontier.
So you might be wondering, where exactly is Aperture EC planning to point this newly minted $90 million vehicle? Well, it's not at heavy industrial trucks this time. According to their S1 filings, they are hunting for lower middle market companies that are building the essential infrastructure of the digital asset industry. They're aggressively targeting a really wide array of tech innovations. We're talking the tokenization of real-world assets, decentralized applications running on permissionless blockchains, core infrastructure like smart contracts, and even the massive data centers required to physically run these networks.
Now, to understand exactly why a $90 million SPAC is targeting this particular sector, you really just have to look at the institutional validation it's been getting. The S1 filing directly cites massive institutions like the Bank for International Settlements and the IMF, which explicitly note that tokenization may improve efficiency across all financial markets. And guys, this isn't just theory anymore. Over $18 billion worth of tokenized real-world assets are already live on public blockchains right now. The ecosystem is maturing fast, and the capital markets are rushing in to fund its infrastructure. We've seen how this exact type of financial vehicle can successfully fund heavy green machinery capable of operating at -40 degrees, and now we're watching it pivot to target the blockchain and digital asset frontier. The mechanisms of capital are constantly shifting, right? Always moving to fuel the bleeding edge of human innovation. Which leaves us with a pretty fascinating final thought. As these public market vehicles become faster, more efficient, and more targeted, what massive, world-changing industry are they going to transform next? Thanks so much for joining me for this explainer, and definitely keep a close eye on the markets to find out.